Welcome back to Bloomberg Businessweek, and welcome to all of our viewers on Bloomberg Television and listeners on Bloomberg Radio worldwide. Joining me now is the president of the Atlanta Federal Reserve Bank, Raphael Bostic. Thank you very much for joining us today, Dr. Bostic. I'm hoping this is the last time we have to do this virtually, that we may be getting beyond this pandemic, because I know this is the time when you would be having your Atlanta Fed conference in person down at Amelia Island.
That's exactly right, Mike. It's really good to see you anyway, and I'm really looking forward to when I can actually be sitting right next to you and having this conversation.
Well, the European Central Bank said today in its financial stability review that it sees remarkable exuberance in markets these days, which obviously takes us old guys back to Alan Greenspan's irrational exuberance, and we remember what happened a few years after that. Do you see any parallels to today's markets, to today's asset prices?
Well, you know, I don't spend a lot of time worrying about asset prices, but I will say that there is a lot of drive that is driven by profits and profitability. And we've seen this through the pandemic period. I think that the markets are speaking for themselves. There's a lot of reason to be optimistic about how the economy is going to progress. And we'll just have to see whether the bets that investors are making get borne out as we go through the next several months.
Well, the ECB went on to say that if U.S. inflation accelerates and pushes up bond yields, spillovers from U.S. equity market repricing could be substantial. Do you take into account the effects that U.S. markets could have on other economies around the world when you're considering policy?
Well, we're the U.S. Central Bank, so we primarily focus on the impact of our policy on the United States. But it is certainly the case that in a global economy, the effects of our policies on businesses and investors worldwide will have a feedback loop back on us. So it's something that we have to understand and appreciate as we think about our policy approaches. But it's not the primary driver. You know, for us, we have our dual mandate of maximum employment and stable prices. And that's really where I try to keep most of my focus.
I have to quickly ask you about one of the stories of the day here. Does the Fed care if Bitcoin or Ethereum or any of the other cryptocurrencies are plunging in value?
Well, you know, I think that, the crypto space is one that's very exciting and interesting to watch. There's a lot of volatility in it. But right now, it's not at a scale, and it doesn't have a reach into the economy that has systemic implications for us. So at this point, it's personal curiosity. I watch these markets and try to understand them, watch it on Bloomberg, for example. But it's not something that I really incorporate very much into how I think about where our policy should be.
Well, if you get FedNow, your coming instant payment system, up and running, is there going to be any need, do you think, for a Fed digital currency? I know as the Fed is looking at it, but is there any cryptocurrency in the Fed's future, or are you going to be able to cover that with instantaneous day one transmission?
Well, you asked two questions here. And, first I would say FedNow, which would be our instant real-time gross settlement system, I think serves a lot of the purposes that you would need look for from a digital currency. So in that regard, I think it takes us very far down the road. But as you know, there have been so many evolutionary developments in the digital currency space that we need to study this and make sure that we understand the implications of those developments for what we're doing here at the United States to determine the extent to which we actually need to have a digital currency that's issued by this central bank. One of the things that's been very interesting on this is that there are lots of issues around this. Questions about the relationship between a central bank and the American public that we really have to sort through. And so that work needs to happen. It's going to take some time for us to get through it. And when we do, we'll take that information as well as what we're seeing globally to make a decision about where to move forward.
Let's turn to monetary policy and the economy now. We haven't had a pandemic like this ever, at least in terms of since we've had data. And in recent weeks, we've had a big downside miss on jobs, a big upside miss on inflation. And I'm wondering, as you try to figure out how the economy is going to evolve, how much trust you can have in your forecasts, in your staff forecasts.
Well, Mike, to start, I would just say you nailed it right on the head. We've never had an experience with a pandemic. There's not pandemic response chapter in econ textbooks. So we're going to have to be very nimble in terms of our monitoring of the economy and our policy responses. You know, when I think about where we are right now from an economic perspective, the word that comes to my mind is transitional. Like, we've gone through this pandemic, we've seen the loss of millions of jobs, and now we're transitioning out of a pandemic space into more of a recovery space. As we've gotten that public health challenge under control with vaccines and better management of social distancing and other measures, now we can turn ahead. And so we're actually transitioning out of the depths of a pandemic into a recovery period. And it's just a lot of moving parts that we'll have to keep tabs of. What I will say, though, is that I'm expecting a lot of volatility over the next several months. They're going to see fits and starts. You mentioned that in the last several months, we've had data points that have not met up with expectations. I think that's to be expected. And what that will mean is that we're going to have to do extra work. And at our bank, we do lots of surveys of business leaders and communities. And we also do a lot of outreach to have one-on-one conversations with folks on the front lines to get a better sense of what they're seeing, and more importantly, perhaps, how they're thinking about what their strategies are going to be moving forward.
Well, let me ask you about those conversations that you have, and we'll break it into two parts. First, unemployment. What are CEOs telling you in your district about whether they can find workers, whether they're having to raise pay?
So I'm definitely hearing concerns. You know, this is in the news reports all over the place, that, you know, the labor market is such that a lot of firms are having problems finding people to fill the slots that they have available. Some are responding by increasing pay, and, you know, some had been thinking about increasing pay before. And this is really just an acceleration of that realization. But I think this question about what's happening in labor markets, what's happening on the employment side, is something that everyone's starting to work through. And here again, I would say the word that comes to my mind is transitional. As we are transitioning, we have policies that were designed for the pandemic, such as the unemployment insurance. That still is going to influence where markets are. But we also have ongoing concerns about just safety in the workplace. We have issues around how do we manage childcare, issues around just burnout. I've talked to a number of people and workers who have said, you know, this has been so stressful, I just need a break, I need to step back. And then others are really starting to think, well, maybe this is a time for me to retire. I've been eligible, I've enjoyed work, but you know, in a pandemic world, you know, there's a lot of self-reflection that goes on that might lead to changes. So there's just a lot going on here.
The other half of this is, if they do give raises, they've got to pay for them somehow. Are companies telling you that they are not just raising prices if they are, but that they are going to continue to raise prices? In other words, an ongoing acceleration of inflation?
So this is where there is some uncertainty. So today, right now, most businesses that I talk to who say they're having to pay more for workers are telling me that they've been able to pass that through into the final price of goods on the marketplace. What they have been less clear on is whether this is going to be the new normal, so that that pace of inflation continues once we get through, say, the summertime, and the relief payments have been spent by so many families, and savings go back to a normal level. So I think this is one of the big unknowns as we move forward, and it's going to be something that I actually spend a lot of time thinking about and paying attention to get a sense of whether employers and whether firms believe that they have a different relationship with consumers and their ability to pass on price increases.
Well, I have to get to the key question kind of early here in the interview, but there's definitely going to be a staring contest between you and the markets, given the volatility and the uncertainty you're talking about as we get data points over the next couple of months. And I'm wondering, with your new framework, can the Fed resist market pressure? I'm sure you'll say yes, but the markets remember December 2018 when we had the Powell reversal.
So all I'll say is yes. My job is to look at the data as it comes in, collect as much on-the-ground intelligence as possible, and then make a judgment about where the appropriate stance of policy is. If we see that substantial, significant progress towards our goals, I'm going to be advocating for us moving policy. Now, we are not there right now, and I want to emphasize, no one should take this as an expectation that I'm advocating that we move our policies tomorrow. We're still 8 million jobs short. We have not had the sustained level of inflation above our target that we are looking for, but I'm paying attention, and because this is such an unprecedented time, I'm going to try to be as prepared as I can for whatever happens coming down the road.
Well, I guess one of the questions everybody on Wall Street trading desks wants to know is, how do you, Raphael Bostic, define the word transitory?
So, what I look for in transitory is really the notion that you have a shock to the economy, either on the supply side or the demand side. It's going to resolve itself, and it's clear that that's going to happen, and that the impacts of that shock don't have long-standing effects in terms of how businesses and how consumers view their approach to producing and buying goods. So if we have an impact and it leads to sort of some temporary or contextual changes in behavior, if that behavior then dissipates and we go back to where we were before, then we're transitory. That looks like transitory to me. If, on the other hand, we see that it leads to a rethinking by business leaders and by consumers about maybe the patterns in their approach to buying goods, then that's going to look a little more structural. But what I will tell you, and you know this undoubtedly, it's very difficult to identify structural changes in real-time data. And this is one of the reasons why I'm spending a lot of time out there talking to business leaders. My team is doing the same, so that we can try to identify those structural changes as early as possible.
Well, how long do you think it would take before you could decide whether we're going back to the way it was or we've got a new normal?
So I think this is going to vary by industry or sector. What I will say is this: I'm expecting a fair amount of volatility through the summertime. And I think businesses are going to be really evaluating their experiences as we see the stimulus payments spent down, as we see families really go through that pent-up demand period. Everyone is really looking to get out and be engaged in the economy and all that kind of stuff. Once we get that settled down, once the kids are back to school, once we start to see how families are allocating their labor and workforce, then I think we will start to get signals from business leaders about how they're thinking about their strategies. So I'm going to continue to ask as we go through the summer. I'm expecting they're going to say, well, there's a lot going on here. Hold on. But, starting in September and moving in through the fall into the winter time, I think I'll start to get some signals that will allow me to answer that question.
I'm looking forward to coming to the next Atlanta Fed Financial Markets Conference, but I'm not sure if you're going to have Larry Summers come back after yesterday's speech there. He told your conference yesterday that the Fed's new framework policy is a mistake, it's too mechanical, and you need to focus on overheating as the main risk to the economy. Can you tell me where and why you might think he's wrong?
So, I actually think that what we said in our statement is that we're going to let experience be our guide. And we're not going to be preemptive or proactive to stop things that may or may not happen. And what we've seen over the last 10 years is that, that expectation that inflation was just going to emerge didn't happen. And so policy could have a sort of an inappropriate or unintended impact on the trajectory of the economy. I don't think that the framework says that we're not worried about overheating. I think for me, when I see the framework and I looked at the words, what it told me was that we're going to look for evidence of overheating before we move definitively. And so in that regard, I don't think that Larry is saying something that different than us. I think he has his own style of communicating, which is very Larry Summers, and I'm not even going to try to replicate that. But I think people just should understand that, for me, I actually do worry about both sides of economic performance to make sure that our policy is deployed in a way that allows us to have a stable, predictable, and prosperous trajectory for growth.
Well, Alan Blinder, who served at the Fed, said today he's not entirely unsympathetic to Professor Summers because he says there is a hell of a lot of aggregate demand out there chasing less aggregate supply. Do you feel you have a good handle on both sides of that, enough to know whether overheating is taking place in time to do something about it?
So I actually do. One of the things that's been very interesting about this pandemic, and it's actually was evident very early on, is that demand has responded much faster to the marketplace than supply has, and it's taken supply time to sort of catch up. And we're seeing this in a number of different ways, whether it be semiconductors or lumber response for housing, or even appliances and their availability for families that are looking to upgrade at their homes. The question is not whether there's that imbalance that happens initially, it's whether that persists over time. And as I've talked to business leaders, what they've said is that for many of these things, they're not expecting them to really last for an extended period, so that the dynamic that we're seeing now is not that new steady state dynamic. And so there's a reason to be less concerned. But I do want to emphasize again, this is why we talk to people on a repeated basis. I want to know whether their views on this are changing, because if they are changing, then that will lead me to have to rethink sort of my approach to where our policy should be.
You put in place $120 billion a month of quantitative easing, bond buying a year ago as an emergency action. Do we still need that much money? Markets are functioning. Bank lending is actually lower than it was, so it doesn't seem to be adding anything to stimulus at this point. Could we do with less than that and still have the economy on the same track it is today?
So I think that's a fair question, and it's something that I'm talking about with my team internally. Right now, I would say I've not come to a clear view on this. I do think that as we continue to move forward, we continue to see progress in the labor market, we see inflation at or above our target. This is a question that we're really going to have to sort of ground ourselves in, and I'm going to have a view on it. I will say, I've said this in the past, I've told you this, I stay open to every possible scenario. And as we see the world happen, I want to make sure that I'm ready with a view on what an adjustment should look like. So as we go through the summertime, as we start to get some of the jobs reports and see where inflation is, I'm going to really try to hone down my thinking on this and be able to articulate this to our committee in a way that hopefully is compelling and leads us to a policy shift when the time is right that accomplishes the things that we're hoping to.
Your background as an economist is in housing, and I'm wondering if you agree with the Boston Fed president, Eric Rosengren, who said the mortgage market doesn't need as much support as it's getting right now. In fact, it might be becoming a financial stability concern. Is there a case for tapering mortgage bond buying ahead of Treasury buying?
Well, I think that's something we're going to definitely have to think about. I actually don't agree with Eric to the extent that what we're seeing in mortgage markets today doesn't come close to approximating where we were at the outset of the great financial crisis, where we had a large amount of subprime lending. There was a lot of fraud in the marketplace, and there was just a lot of, we'll just say, not good behavior going on. That's not happening today, and in fact, what we're seeing is, and what I'm seeing is, home buyers eagerly trying to engage in the marketplace, home sellers far less eager to put their homes on the market, in part, I think, because we're still in this transitional period. And so there is that imbalance, and new home construction is struggling because of input costs. So I think there's some foundational issues in the housing market that can justify where we are today. My hope is that some of these supply issues get resolved, and consumers and homeowners return to their mindset as to how frequently they want to move and how willing they are to engage in the sales market.
Before we let you go, I wanted to ask a little bit about the Fed's focus on helping the poor and marginalized sectors of society. There's some concern that you'll be so focused on that you'll be late to respond to inflation. And there's other concerns that it's a hard sell to certain aspects of the American body politic because it's sort of outside your remit.
Well, to the second point, I actually think that it is very much inside our remit. You know, I worry about, you know, economic prosperity and an economy that works for all. If we do that well, our economy will grow faster, it will be more innovative, and it'll be more resilient. So anything that's a barrier to that, I think is something that is worthy of talking about, and letting policymakers know that we're seeing it and that they should be thinking about ways to act. I think that falls well within our purview. When we think about, you know, is that going to become too much of a focus? You know, I actually don't think that that's really something, that's not something I worry about very much. I think that we're going to take, and I'm going to take, as broad a perspective as possible on how labor markets are performing. And, you know, my job is to do risk management and weigh the various factors that are out there to come up with good policy. So I won't forget everybody else, but this is just going to be one more data point that I have in thinking about where we should go.